The bad news is that the Fed has become extremely aggressive and hawkish. The good news is that we are beginning to get data that is confirming that the economy, the US economy, is in recession. And if you've tuned in before, you know that we believe that that Europe and China effectively have been in recession as well. So now a global recession. We're also getting a lot of indicators that prices are coming down. And I think this notion that the inflation that everyone has been worried about is quite a wrong way of looking at the world right now. We believe that deflation is the much bigger risk. We've been saying this for a time. We've been ridiculed for saying it. And we were challenged by those who were sure that we were back into a 70s style inflation scenario. We think the pricing action, and I'm not just talking about stocks and bonds, I'm talking about commodity prices, crypto prices, and perhaps soon even housing prices, that many people will conclude the greater risk is deflation. And as you know, we don't think deflation is a bad thing per se. It is a bad thing the way the Fed has approached it, we believe. But deflation can be a very good thing if it is caused by technology and progress. And we think we're going to see a lot of that over the years. But right now, we're looking at bad deflation. We're going to have to get through this. I think the next Fed move is supposed to be at the end of this month. And the Fed is out of its quiet period. So all the Fed governors have been traipsing out saying we're going 75 basis points, another 75 basis points. Well, we think that they will rethink that in this month as we get not only more pricing signals, but earnings reports and guidance from companies who will be probably confirming that the US is now in recession. So bad news, good news. Darkest before the dawn. We called this segment Finding Growth. We think growth is going to be scarce this year. And as you know, innovation is all about growth. Innovation is also about solving problems. We have a lot of problems now. A recession is going to be providing another set of problems. So lots of work for innovation to do, and that's where we believe you will find real growth. I did a tweet thread last weekend and basically concluding that the Fed right now is much more worried about its own legacy than it is about the economy. It is so afraid that it has let the inflation genie out of the bottle and that it won't be able to get it back, that it is in unison basically going out there and saying, we are going to tighten. We have an unconditional commitment to 2% inflation. Well, I'm going to be sharing with you a lot of indicators that will suggest that using the CPI as its guide, the Fed is making a big mistake. There's already a lot of deflation in the economy. And one of the reasons the deflation is accelerating here is because the Fed has shocked the system. We've never seen that before. Now, I know a lot of critics are suggesting, oh, what are you talking about? From such a low level. You can't make a comparison to the early 80s when Fed funds rate went from 10 to 20%, which was only a twofold increase. You just can't make that comparison. Well, yes, I can. I can make that comparison up fivefold very quickly. I think the Fed has panicked and it's causing the economy a lot of problems. As I mentioned before, though, it's becoming obvious now, and I do believe they will change their tune with a few more reports. So what are the deflationary signals we're seeing out there? Well, one of the most obvious, but one that very few people mention, or maybe they don't monitor, are credit default swaps, CDSs. Now, this is the price of insurance against bankruptcy. So when the price of this insurance goes up dramatically in a short period of time, I certainly take note. So the 5-year CDX, as measured by Markit, M-A-R-K-I-T, has gone from 50 to 100 year to date. For JP Morgan, so a money center bank, it has gone from 48 to 102. So JP Morgan's credit default swaps have gone up more than the market's average. That's very interesting. And we're trying to figure out, what is that all about? We know that JP Morgan is a fortress. It's not going bankrupt, but there are some investors concerned that there might be something systemic going on. And so why not take out the insurance? Now, 102 is quite a bit below 0809. We were at 239 then, and below COVID, 172. But it is above where we reached in the fourth quarter of 2018, 80. That was a vicious market downturn in only a quarter's time. So I think it was from September to December. This doubling in credit default swaps for the market's average and JP Morgan has us asking questions. Is there something systemic out there? Our guess is that if there is, it has to do with the reach for yield that we saw during the last few years as interest rates went effectively to zero on the short end and as low as 0.5% for the 10-year Treasury bond yield during the coronavirus. Now, reaching for yield, if on top there's leverage, could be a problem. Now, one of the reasons we don't think this is going to be a problem is because of what happened a little more than a year ago with the Archegos blow-up. Apparently, one bank didn't know the amount of leverage that Archegos had taken on, and this was true across the banking system. And so that's how that situation became so leveraged. I think risk officers are now looking for excessive leverage. And so we would be surprised if there is going to be a systemic risk, but we do want to note that the concern is out there and it is elevated. Interestingly, and speaking of JP Morgan, the chief investment officer of its asset management unit came out yesterday, and I found it difficult to believe given that he's right in the middle of the bank. But he basically said, the Fed waited too long, and now it's going to have to work that much harder to get inflation under control. I think he's ignoring an incredible number of signals, the first of which I've just shared with you, credit default swaps. The other one is the yield curve. It is flat. It did go negative for a time in April. We've never in post-World War II seen the yield curve invert without a recession soon thereafter. And we think we're in a recession and that it happened as the yield curve was inverting. When we've moved into crises, we've seen monetary and fiscal authorities easing quite significantly, trying to stimulate the economy, acting as a counterbalance. And often, and certainly since the early 90s, when this has happened, the yield curve has steepened to the 250 to 300 basis point range. So that's 2.5 to 3% range. And what this means is long-term interest rates are 2.5 to 3 percentage points higher than short-term interest rates. And the reason for that is investors begin to worry about the inflationary ramifications of fiscal and monetary stimulus. So 250 to 300 is where I thought we went in the middle of the COVID crisis, because we have never seen monetary and fiscal policies as stimulative as we did during the coronavirus, when we thought we could enter a depression, just the economy, global economy shutting down. So I was surprised as we looked back to see that the yield curve steepened only to 150 basis points or 1.5%. What does that mean? What does that mean? I think it confirms that the bond market, in its wisdom, was beginning to worry about deflationary undercurrents. And so to see it flatten so quickly and having only gotten to 150 basis points is very interesting. The last time we saw the yield curve after a recession or during a recession getting only to 150 basis points was in the early 80s. Now, inflation and interest rates were raging at the time in the double digits, and the Fed had gotten very, very tough. The dollar was rising fairly dramatically. And what happened was the Louvre Accord was when Treasury authorities from around the world all got together, including the US Treasury Secretary, and said, okay, we've got to supply the world with dollars. We'll sell dollars and buy back the other currencies. And that's what happened. So the dollar back then was very deflationary, especially for emerging markets who had a lot of debt that was denominated in dollars. So their currencies were falling apart, but their debt was denominated in dollars. And so it was becoming much more expensive for them to service that debt. We may have a similar situation now. Perhaps the dollar going up, and it's up more than 10% over the last year, which is a massive move if you're in emerging markets and your currencies are plunging, as many are. So there is a likelihood that this is saying more about the deflationary undercurrents in the rest of the world, much like it did in the early 80s.